On April 23rd, 2026, Meta announced it was firing 8,000 people. The stock fell 4%. Then, the next morning, the stock rallied back up 2.41% and closed at $675. And from this moment, we learned two things. First, the best time to buy Meta stock is apparently the day after they announce mass layoffs, which tells you everything you need to know about who Wall Street actually works for.
And second, the mainstream media explanation for why this happened is the most conveniently incomplete story of the year. Because here is what every headline told you. Meta is streamlining. AI is creating efficiencies. The market is rewarding disciplined cost management. And here is what those same headlines very carefully left out. The night before that layoff memo leaked, Meta awarded its 6 most senior executives stock options worth up to $921 million. Each, not combined, each. And on that same earnings call, Meta reported $26.8 billion in net income in a single quarter, up 62% from the same quarter last year. This was not a struggling company making painful cuts to survive. This was the most profitable quarter in Meta's history, and they fired 8,000 people anyway. So the question is not whether Meta can afford its workers. The question is what Meta is choosing to spend that money on instead. And the answer to that question is already affecting your job, your retirement account, and a bill that showed up at your house this month that nobody connected to any of this. Here is the real story underneath the headlines. Meta, Microsoft, Amazon, Google. These 4 companies will spend $725 billion on AI infrastructure this year, more capital than the entire global oil and gas industry spends on exploration, and every single dollar of it is coming from somewhere.
3 places specifically. The salaries of workers who'd just lost their jobs. The retirement accounts of investors being bet on technology that mostly does not work yet. And your electricity bill, which went up this month for a reason nobody explained to you. 3 dominoes. Let us follow the money. Let us start with what Meta's earnings actually said, because the numbers tell a story that is very different from the one on the front page. Q1 2026. Revenue, $56.3 billion, up 33% from a year ago, fastest growth since 2021. Net income, $26.8 billion, up 62% from a year ago. Earnings per share, $10.44, up from $6.43 the previous year. This company is not struggling. This company is printing money at a rate it has never printed money before. And it fired 8,000 people the same week. Now, Meta's Chief People Officer Janelle Gale wrote this in the internal memo that leaked before the company was ready. The layoffs were, and I am quoting her directly, part of our continued effort to run the company more efficiently and to allow us to offset the other investments we are making. The other investments she is referring to? Meta has committed $135 billion in AI capital expenditure for 2026, almost double the $72 billion they spent last year. Microsoft, $190 billion this year on AI. Amazon, $200 billion committed. Google expected to match. Combined, these four companies are spending $725 billion in AI infrastructure in 2026, up 77% from last year's already record $410 billion. And since 2020, nearly 900,000 tech workers have been laid off globally, 92,000 of them in 2026 alone. The first wave in 2022 blamed pandemic overhiring. The second wave in 2024 blamed restructuring. The third wave, happening right now, the companies are not even pretending anymore. Janelle Gale's memo is the clearest statement any Fortune 500 executive has ever put in writing. We are firing people to pay for AI.
Now, the mainstream explanation is predictable. AI creates more jobs than it destroys. New technology always does. The Industrial Revolution eliminated farm jobs and created factory jobs. The Internet eliminated travel agents and created app developers. Think long-term. And look, that argument has been true historically. But it assumes the technology actually works well enough to create those new roles. And here is where it falls apart completely. MIT studied companies that had spent between $30 and $40 billion deploying generative AI. 95% reported zero return on their investment. Not disappointing, zero. Then a separate firm tested AI agents on 480 real professional tasks, the kind that bankers and lawyers do every day. Every single agent failed to complete most of them. Every one. So, the companies are firing the humans. The AI cannot do what the humans did, and the solution is a 77% increase in spending. I want to pause here, because I need to tell you something that nobody in the financial press has connected yet. And this is the part that genuinely should stop you cold.
Mark Zuckerberg spent $80 billion on the metaverse. $80 billion. He changed the company's name from Facebook to Meta. He put on a VR headset for every earnings call. He told investors this was the future of human connection. He promised billions of users in virtual reality. As of March 2026, the metaverse has been almost entirely abandoned. The users never came. The advertisers never came. The money is gone. And nobody went to prison. Nobody gave the money back. And Mark Zuckerberg is now spending $135 billion on AI with the exact same confidence he spent $80 billion on the metaverse. Same CEO, same promises, same investors. Different technology. And the question that CNBC has not asked once is what happens to those 8,000 people if this one fails too.
This is the mechanism nobody explains on cable news, because the answer is uncomfortable. When Meta fires 8,000 people, those salaries disappear from the expense line. Earnings go up. Stock price goes up. Your 401k, which holds Meta, goes up. Which means everyone with a retirement account financially benefits every time a tech company fires someone. Not because the company became more valuable, not because the technology got better, but because human beings are the most expensive and flexible line item on a balance sheet, and Wall Street rewards companies that cut that line. So, here is the uncomfortable truth that your financial advisor will not say. Your retirement account is not just invested in AI. Your retirement account is actively incentivizing the replacement of human workers with technology that currently cannot do their jobs. Think carefully about what that means. Here is the second domino. Think of buying a brand new iPhone for $50,000. You plan to use it for 5 years. 2 years later, Apple releases a model 10 times faster at half the price. Your old one still works, but nobody will pay you to run it anymore. Now multiply that by 100,000 iPhones. That is what is sitting on Microsoft's balance sheet. Goldman Sachs modeled this specifically. A single AI accelerator chip costs $50,000. Standard accounting depreciates it over 5 years. But AI chip generations are advancing so fast, these chips become economically obsolete in 2 to 3 years. Not broken, economically obsolete. Goldman's conclusion: the Asaurus becomes a threat to the fundamental economics of the AI ecosystem. To justify the returns investors expect, these companies need $1 trillion in annual profit. Current Wall Street consensus for their combined profits, $450 billion. They need $1 trillion. They are tracking $450 billion. The workers were cut to fund infrastructure that will be obsolete before it is paid off, and your retirement account is priced as though the $1 trillion happens. Your electricity bill went up 4.6% this year, not because you are using more power, because Amazon needs to keep its GPU clusters cold. Goldman tracked U.S. electricity production directly. After more than a decade of flat output, power generation rose 2.5% in 2024, then 2.4% in 2025, then 3% in early 2026, all driven primarily by data center demand. Goldman estimates this continues adding to your cost of living for at least the next 2 years. So here is the complete picture. 8,000 people lose their jobs to fund AI that cannot do their work. The infrastructure will be obsolete before it generates the returns promised. And you are paying higher electricity bills every month for data centers training the AI that took the jobs that were cut to pay for the data centers. That is not speculation. That is Janelle Gale's memo and Goldman Sachs's electricity data and MIT's ROI study sitting in the same room together. And here is the thing. We have watched this exact movie twice already. Go back to 1999. Telecom companies laying fiber optic cable across the country at the cost of hundreds of billions of dollars. The internet was the future. Bandwidth was the future. Whoever built the most infrastructure would win. By 2001, 97% of that fiber was sitting completely dark. 360 Networks, Global Crossing, WorldCom, all bankrupt. Investors lost $5 trillion. And now go back to 2021. Mark Zuckerberg betting $80 billion on the metaverse, the future of human connection, billions of users, advertisers lining up. By March 2026, abandoned. $80 billion gone. Now he's spending $135 billion on AI. Goldman projects $7.6 trillion in cumulative AI infrastructure spending between now and 2031. $5 trillion lost in the dot-com crash, $80 billion lost in the metaverse, $7.6 trillion now committed to AI. Jim Covello, 30 years as Goldman Sachs head of global equity research, called the 2008 financial crisis, does not use the word unprecedented lightly. Said this publicly: replacing low-wage jobs with tremendously costly technology is basically the polar opposite of every prior technology transition I have witnessed in 30 years of this industry. And his question has still not been answered. What $1 trillion problem does AI actually solve? Not eventually, right now, this year, while 92,000 people are losing their jobs to fund it. Nobody has answered.
Here is exactly where we stand. Meta reported its most profitable quarter in history, then fired 8,000 people. Then the stock went up. $725 billion is being spent on AI this year by 4 companies your 401k holds. 95% of organizations deploying that technology are seeing zero return. The AI cannot complete most professional tasks. The chips will be obsolete before they are paid off. Your electricity bill is already going up because of it. And 79% of Americans are concerned the government has no plan to protect workers from what is coming. Not 9%, not 19%, 79%. And the same CEO who spent $80 billion on a metaverse that 3 billion people chose not to visit is now the most trusted voice in AI.
Now, maybe this all works out. Maybe AI is different from the metaverse. Maybe it is different from fiber optic cable. Maybe $26.8 billion in quarterly profit and $135 billion in AI spending and 8,000 fewer workers all adds up to something that benefits more than 6 executives and their $921 billion in options. Maybe. But the financial media is not asking any of these questions. Because Meta buys ads, Microsoft buys ads, the companies laying off 92,000 workers fund the platforms supposed to be covering what those layoffs actually mean. That is not an accusation, that is a business model. So if you want the version of this story they are structurally unable to tell you, subscribe, because the people who thought this was someone else's problem are the 8,000 people who got the memo on April 23rd.